People are constantly trying to predict when the next stock market crash will happen, but the only certainty is that nobody can predict when exactly it will occur. Crashes can be sudden and unexpected, so it's important to be prepared. For example, on October 19th, 1987, also known as Black Monday, the Dow Jones dropped 22.6%. Just this weekend, we had people like Jim Cramer suggesting that we were in for a Black Monday 2.0. He said that the market could fall another 20%. However, after a sharp fall to start the day, the S&P 500 actually went up and was briefly positive, only down slightly overall. So is the 2025 market sell-off over? The reality is, we don't know. The market is still acting with extreme fear, and there is ongoing uncertainty around tariffs and trade across the globe. And by the way, that news continues to evolve by the hour. That said, in times like this, there can be opportunities for the long-term investor. As Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. Today, I'm going to share my plan on how to prepare for the possibility of a 2025 stock market crash. I'll share which stocks I'm targeting and why. My name is Zach. This is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. And by the way, if you were wondering what I was referencing on screen earlier, that was my weekly email newsletter, which gets sent out every Monday morning. So click the link in the description and pin comment if you want to join and sign up to that. It's 100% free. So even though we didn't have Black Monday 2.0, I was still down over $1,000 on the day in my dividend growth portfolio, which I update every single month on the channel. Just in this account, I lost $13,000 over the past week. My total return is now down to 45%. And across all three of my investment accounts, I am down a lot more than that. In fact, just on the Friday sell-off last week, I had lost $18,000. And seeing big losses like that can start to psychologically get to you as an investor. But it's important to remember that those losses are only on paper. A potential market crash is nothing to be fearful of, and this is shown time and time again by history.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
Nobody knows exactly when a market downturn will occur. The most important thing to remember is that corrections and crashes can actually be an opportunity. A stock becomes less risky, not more, as it goes down in price. As a long-term investor, you have to have the stomach to buy, not sell when the market goes down. Flipping that mental switch is vital to successfully navigating a market crash. As Warren Buffett says, buy when there's blood in the streets, even if the blood is your own. Beyond that, you need to actually be prepared and set your action plan for a market sell-off. And the number one lesson I learned from my experience in the 2020 market sell-off is that you should focus on quality. At that time, I took the spray and pray approach, buying countless companies which sold off, and I was spread way too thin with many lower quality stocks, and I missed out on some of the great opportunities in the highest quality companies. I also blew through my cash position right away. You need to stay disciplined and focus on quality. The best companies are the last to sell off and the first to recover. So what I recommend doing is creating a watch list of stocks. You can write it down or use a tracking tool like I have over at dividenddata.com, but you want to stay focused on your highest quality opportunities. Like for example, with me, I'm focusing on my long-term total return in some dividend growth stocks. So I am mostly only buying Google and Microsoft and a share of TPL. I also have a few other companies on my watch list. And if you want to know why I'm targeting stocks like Google and Microsoft, I recently discussed this in my last portfolio update video, so go and watch that if you want more information. But this list will be slightly different for everyone depending on your investing goals and time horizon. But the only way you'll even have a list is if you're putting in the work and actually researching some of these businesses. If you're investing in individual stocks, you gotta do the legwork to identify quality businesses. Over the long term, the actual quality of the business is the most important factor when investing. I think Warren Buffett has provided great advice on when to actually buy a quality business.
In general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. To sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, "Look, my brother just died and he owned 20% of the business, and I want somebody to go in with me to buy that 20%, and price looks a little high maybe, but this is what I think I can get for it. Do you want to buy in?" I think if you like the business and you like the person who's coming to you and the price sounds reasonable, and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. It won't be quoted tomorrow or next week or next month. I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way. So,
To summarize the main points of this video, a stock market crash is nothing to be fearful of. In fact, it can actually be an opportunity for long-term investors. You should prioritize buying quality businesses that you want to own forever. For me, I look at Google and Microsoft as companies I want as core positions of my portfolio going into the future. That said, you shouldn't only wait for these crazy market crashes to invest in stocks. Time in the market is better than timing the market. It is extremely rare to accurately time the bottom of a stock market crash. The best you can do is buy a great business at a price you find attractive. I hope you found this video to be valuable, and make sure you leave a like and subscribe to the channel. I'll be on the ball providing market analysis during this volatility. And if you want to research stocks with the same tools that I use, then head over to dividenddata.com, which is the best research tool to identify high quality dividend stocks. The link is in the description and pinned comment of the video. With that said, thanks for watching, and I'll see you in the next one.